I think this administration is focused very heavily on geopolitical security, in particular, energy security. The biggest hammer they have is oil prices. I'm looking at Venezuela and I'm looking at OPEC spare capacity. I'm looking at lack of shale discipline. I'm thinking we're solving for the wrong problem. We're looking in the rearview mirror, focused on oil when we actually need to focus on natural gas.
Welcome to Monetary Matters. I am joined today by Michael Kao, CIO of Akanthos Capital Management and the Kao Family Office. Michael, thank you so much for joining me today.
Thanks for having me. It's been a long time, Max. It's great to be back.
It has been a long time, and what a timely moment to have you. I know we're going to be talking about the U.S. and how we are strapped for energy. Obviously, there was a huge geopolitical event that happened to start this year off that pretty much screams that the U.S. is concerned about where we are going to get our energy, and that is the removal of Maduro as the head of Venezuela, and basically the administration outright saying we're going to go there and we are going to pump oil. What did you make of this move by President Trump and his administration?
If we play our cards right in the longer term, and that's a big if, right? Because I think the U.S. has had a checkered history with respect to enacting lasting regime change, right? I do think that it could be a game changer in the long term because, look, it's well known that Venezuela sits on the world's largest reserves, but it's also well known that their infrastructure is somewhat antiquated and degraded, right? Yesterday, last couple of days, I've been on numerous calls with various, energy CEOs, macro strategists and whatnot. And the consensus, my favorite oil analyst, I quote from Capital One, Lakshmi, she thinks that in the near term, in the next 3 months or so, we could see a potential addition of maybe 300,000 to 500,000 barrels. But within the next year, the max we're going to get is about, call it an incremental 800,000 barrels per day. But then that gets us to around 2 million barrels per day of production in Venezuela. And to get the incremental 1 million barrels per day to 3 million barrels per day, that's going to take some doing. She thinks that it could take an aggregate investment of close to 100 billion over the course of a decade to get there. So, but see, what I find ironic about all this is I think that the U.S. has already been shifting away from a hydrocarbon dependency on oil for some time. I mean, most obviously from the shale revolution of the last decade, right? Something like a Venezuela will really sort of hammer that home, that we're not nearly as dependent on oil or on OPEC as we were in past decades. But what I find ironic, though, is that I think we have traded one hydrocarbon dependency for another. And the other one is the one that I'm kind of interested in right now, which is natural gas.
You already talked about it's going to take a while to get this oil pumped. What about the break-even price? Is it even economic to ramp production as much as you're saying? Is this $100 billion investment that is going to be required to ramp up that production, is that even economic? And is it going to come from the U.S. government, or is it going to come from the private?
I don't think so. I think it has to come from private companies ultimately. And yeah, I think that from what I understand, the ultimate lifting costs will be much lower than shale, right? But again, these are conventional long-lived projects that take a lot of initial capex upfront, and a lot of the capex is going to be for the transport infrastructure as well. The resource is definitely there, right? And it's a different resource than what we have here in the U.S. What I think is kind of interesting, though, is, for years I've talked about this elusive oil supply-demand singularity point, right? Which is, this magical moment where, if you're an oil bull, you're hoping that at some point when the spare capacity of Saudi Arabia runs out, and at the same time you have uh, uh, coordinated central bank easing. You have this potential inelastic response in price. The issue I see with that, and it's exacerbated by this Venezuela news, is that right now there is a lot of concern over when the Permian Basin is going to start declining. Right, the Permian Basin is really it's the most prolific shale basin, and it's the only basin that's technically not in decline yet. Every other major basin is. So when the Permian finally declines, right, there's going to be a huge gap in supply. But see, if it's going to take 5 to 10 years to develop, say, Venezuela, and here's the biggest and the fact that OPEC spare capacity is still sitting at 5 million barrels per day. Well, it gives enough time. A lot of time will pass before that spare capacity gets eaten up. And then by then, a country like Venezuela may have already made those investments, and now that resource is now starting to come online. So you never get to that perfect oil supply demand singularity point, right? And so that's what makes me structurally bearish on oil. I also think, I know we're going to talk about it, but I also think that just the electrification economy fundamentally, and not just here in the US, China especially, right, is shifting the demand picture away from one hydrocarbon to another one.
We're looking at like $62 Brent right now. If you listen to Trump, he says he wants them to drill and pump and get the prices lower. I would say prior administrations would have loved to see oil prices at $62. Like, how low do you think oil prices can go? And obviously, if you are one of those companies that's going to be expected to invest this $100 billion, you want oil prices higher. How are the dynamics between the companies that want structurally higher prices and an administration that wants structurally lower prices going to play out?
See, here's the problem, right? So we had lack of discipline in spades in the early years of the shale revolution, right? I'm talking about that period of time between 2014 and 2018, right? And the oil bulls will tell you that now everything is different. Everybody's much more capital discipline and whatnot. Well, I can tell you that like this week, I was on a conference call with two prominent oil CEOs, one of a private and one of a public company. And I thought what the public CEO said really struck me, which was, "Hey, years ago when we basically laid down some rigs and cut production to show that we were disciplined, the capital markets really punished our stock for it." And so he was expressing frustration at how public market investors kind of speak out of both sides of their mouth. They want capital discipline, but then when it happens and production drops, they punish the stock. So then the next comment was that it forces us to do things that we don't necessarily want to do, meaning continue to produce and complete wells in a environment where WTI is like 56, 57, right? So what the message that I got from this is that in this no man's land here, a lot of these public CEOs are still pressured to continue producing. They might be laying down rigs, but laying down rigs, given the amounts of efficiencies that have occurred in shale technology, what you really want to see is what they're doing with their completion crews and their frac fleets. And so they're not necessarily laying down enough of those fleets right now to really make a dent in production. So this Permian is about to roll over story keeps getting extended and extended and extended. So, I'll see it when I believe it. At some point, it will happen. I mean, it's a shale resource. It has to happen. But I actually think that, they could continue on like this unless oil, WTI, I'm talking, drops into the 40s. Drops into the 40s. This CEO would tell you that, at that point, the whole industry will lay down their frac fleets, right? Because now the whole industry is in pain, but we're not at that point yet, and that's what's makes me kind of wary on oil, even after it's been in this sub 60 range.
Yeah, and I guess one of my questions would be, we just saw the executive order where he talked about a $5 million cap on executive compensation for defense contractors. Could you see a world where the administration says, we want you to pump, and those compensation structures, which used to be tied to production at any cost, which have moved more towards returns for shareholders, start to move back towards production at any cost, because that's what the administration's goals are, and more of the state capitalism starts to come into play?
I think the Trump administration, right, is very, very focused on trying to get to this nirvana of disinflationary growth. Okay. But to get there, when you have a pre-existing inflationary backdrop, you need to have a deflationary playbook to kind of counteract that, right? To get to like a neutral disinflationary growth objective. And I think the biggest hammer they have is oil prices. Now, on this call I had yesterday, I kind of wondered out loud, I wonder what how MBS is feeling about this, because it's a little bit reminiscent of what I call the infamous Trump rug pull of Q418. If you recall, in 2018, Trump had just taken us out of JCPOA, right? And you saw oil prices start to move higher because he said that there would be no waivers on sanctions on Iranian crude, right? But then he waited till the last minute after he got MBS to flood the market to offset the loss of Iranian barrels, and he grants 11 waivers, and so the price of oil then collapses, right? Well, here, I think that he has convinced MBS to loosen, to roll back a bunch of these unilateral cuts that they made over the last several years, right? And gotten oil down into the 60s and now 50s. But now, all of a sudden, we just decapitated the head of the snake in Venezuela. So that's kind of like a different version of a Trump rug pull, right? So I don't know that Saudi Arabia is necessarily happy about that.
Obviously, there is an energy component to this show of power, but you are somebody who focuses on more than just that in the geopolitical space. There's already talk about Greenland, maybe Cuba, the broader Donroe Doctrine, as it's being called, and exerting his influence over the Western Hemisphere. Like, do you think this is just the start?
Last year, I wrote 2 pieces about how, you remember, like, especially in the wake of Liberation Day, there were so many criticisms about how this seems like just random policy. And I said, no. I wrote 2 pieces saying there's a method to this madness, because if you just take the tariff strategy in of itself, there's a heavy geopolitical component to the tariff strategy. It's not just that we want tariff revenues. No, I almost think the tariff revenues are a sideshow relative to the using tariffs as a cudgel to basically get companies to make these big reshoring commitments. So big, in fact, that like when I tabulate the headline numbers across all the different deals, it's something like 12 or 13 trillion dollars. Now you can haircut that haircut it by 70-80%. It's still a huge number. So I've made a term for it. I call it the reverse Marshall Plan, and I think that's very, very significant. And with respect to these other geopolitical flexes, it really it all dovetails together in this sort of this America First playbook. I think this administration is focused very heavily on geopolitical security and in particular energy security.
Now, there is a level of energy security that you don't think we have. So you think we're pretty set on oil, especially with this move in Venezuela, but you're concerned about natural gas.
That's the irony of it. So let me just start here. I think that, you know, if you look at my thesis on natural gas is predicated on three pillars, right? We over the last 10 years, we've had this massive ESG inspired push to electrify our economy, right? And in my most recent piece, I call it the U.S. energy Achilles heel. I basically said that, look, reasonable people can agree to disagree on whether or not the right variable to solve for was the removal of atmospheric carbon, right? But I think what is kind of unequivocal is the lack of consideration of downstream effects of premature electrification, if I might use that as a little pun. So premature electrification without thinking about the downstream effects means that we have a state of grid fragility, right? There's a great book that I recommend people to read if you're interested in this sort of topic of grid fragility. It's called Shorting the Grid by Meredith Angwin. I read that book years ago when I was writing my sort of West Point policy paper about national security issues. And it comes down to this, that, you know, when you have, like, you take a state like my home state of California, where you've had this unconstrained growth in rooftop solar. Now, think about so solar and wind are what we call intermittent sources, right? So they cannot be reliable baseload capacity because, let's face it, the sun doesn't always shine, the wind doesn't always blow, right? And so for every iota of these renewable intermittent sources that you add and connect to the grid, you have to add an iota of peaker capacity. It's usually natural gas to fill in the gaps. But it creates all this volatility within the grid. But underneath this volatility, you have to still have a bed of stable baseload, what we call baseload generation. Baseload generation, you know, in my research for this piece, I basically came up with, basically, there are really only four viable sources of baseload generation. There's coal, which is a non-starter for us here in the U.S. because of ESG mandates. And, you know, we're decommissioning coal plants while China's, you know, building as many coal plants and nuclear plants as they can. The second source is nuclear, but nuclear has suffered from this forever NIMBYism where, you know, despite so many talks about the nuclear renaissance, if you look at the relevant charts of nuclear's share of electricity, it's basically been a flat line for decades. Okay, there's a new technology of geothermal, essentially, basically repurposing sort of fracking technology to drill down into the Earth's core. Right, that's still relatively nascent. But then there's natural gas. Now, when you look at these four sources of baseload generation, what really stuck out to me was that in all cases, whether it's upfront costs, whether it's levelized costs on an ongoing basis, and whether it's time to market, all roads lead to natural gas. Natural gas has the advantage in all of those fronts. First of all, this ESG mandated premature electrification, okay, has ironically resulted in two big dependency shifts. One, it's shifted our traditional, in an effort to get away from a historical dependency shift on OPEC, we've now ironically become more arguably more geopolitically dependent on China, because a lot of the green economy requires rare earth elements. And we all know about China's chokehold on rare earth refining, right? Like 90%. So in my West Point paper, I basically said, isn't it kind of silly that, we're concerned about a quote 40% OPEC dependency, right? Even though we're producing more oil than Saudi Arabia, but then now we've traded it for a 90% dependency on rare earths. So that's a nonsensical trade-off in geopolitical dependency. But then the other dependency is this trade-off, this shift from a hydrocarbon dependency on oil to a hydrocarbon dependency now on natural gas, because I just explained to you how all roads tend to lead to natural gas as like the lowest common denominator for the I guess the lowest hanging fruit for baseload capacity. Now, so that's pillar number one of my thesis, this whole premature electrification thesis, right? But pillars 2 and 3 are that, well, number 2 is the obvious one of AI, right? Everybody's talking about this massive AI data center land grab. And as we all know, AI data centers require 24/7 baseload. You're not going to, you cannot be powered by intermittent sources, right? Nuclear would be ideal, but we talked about that as well, right? And then the third pillar to my thesis is LNG, export capacity. So I think this is also very interesting because years ago, when LNG first sort of got developed as a technology, if you remember, like, Cheniere Energy, these guys basically built all these regas facilities here. We were set up to import LNG. And then the shale revolution happens, and it turns out that, with oil comes all this associated gas. We have this surfeit of natural gas. And so they basically retooled all of those facilities for export, right? Now, enter the Russia-Ukraine conflict of 2022. The Europeans found that, holy shit, maybe we shouldn't have decommissioned our nuclear. Holy shit, maybe we shouldn't have become completely dependent on Russian gas. So now there's this big push to build LNG export capacity here and LNG regasification capability in Europe, right? This is a geopolitically inspired situation. So you take all three of these things combined, and these are new sources of demand pull on natural gas that we've really, frankly, never seen before. So in my piece, I rely heavily on a lot of the analysis from J.P. Morgan, Michael Sembalist, who I have a lot of respect for as a deep thinker. In early 2024, he put out this very comprehensive paper called Electrovision. And in it, there's a chart that I'm going to refer to where he talks about how electricity demand has basically been flatlined for 15 years, from the period of 2005 to roughly 2020. During that period of time, electricity growth was around like 0.5% per year. Now, in the last several years, and we're not even counting this, what just happened in the latter half of 2025 with this mad rush towards AI data centers. Just in the last 3 years, various energy think tanks and agencies have had to revise up their growth. The latest forecasts that I've seen are saying that electricity demand is now likely to average between 2.5% to as high as 5% over the next decade. If we hit the 5% mark, think about it. That's a 10x from 15 years of essentially flatline 0.5% electricity growth. And by the way, here's the other chart that I'll reference in my piece. There's another chart that shows how natural gas is now the dominant share of electricity in the U.S. at around 43%, compared to coal, nuclear, renewables, et cetera. So natural gas has grown steadily as the dominant share of electricity generation here in the U.S., and that's happened despite the fact that we've had flat electricity demand. What will happen if we actually have a 10x demand growth in electricity, what will happen to natural gas, right? So that is basically the crux of my thesis here, and why I'm sort of I'm looking at this, and I'm looking at Venezuela, and I'm looking at OPEC spare capacity, and I'm looking at lack of shale discipline. I'm thinking we're solving for the wrong problem again. We're looking in the rearview mirror, focused on oil when we actually need to focus on natural gas now. To put it into starker relief, it's the equivalent of adding 15 New York City's worth of electricity demand by 2030. That's staggering.
Yeah. But my question would be, all right, so natural gas has been taking share. Yes, you're talking about a higher level of overall electricity demand, but even with that gain in share up outside of the spikes that we saw around 2022 and the invasion in Ukraine, the price has been kind of around its historic price. So are you worried about a price spike? How is this going to play out?
Henry Hub first started trading around 1991. And I remember this because I had just started my career at J. Aron at the time. I was trading GSCI futures, and I remember the natural gas desk was very much a nascent desk at the time. So anyway, so Henry Hub only goes back to that period, 1991. And if you look at this long-term chart, for the first, from 1991 to call it, year 2000, natural gas kind of stayed between, I'm going to say $2 to $4 per MMBTU, right? And then during a period between 2005 to 2010, you had a couple of big spikes. There were weather related, hurricane related, et cetera. And then the shale revolution happens in the 2010s, and then you had a period of low gas prices again, and then you don't have this big spike again. Solidly above 5, 6, 7 until the Russia-Ukraine war started, right? But if you think about Henry Hub, natural gas is a totally different animal than oil. Oil is what I call a global commodity because the oil basically gets transported by barrels. Oil tankers traverse the world around. There's a very well-defined spread between WTI and Brent, right? That arbitrage is fully open. Natural gas is what I call this provincial commodity that's basically landlocked. It's because it's primarily transported by pipeline. And it wasn't until the advent and the invention of LNG where hey, we can actually make it transportable by barrels, by LNG tankers. But it's expensive because you first need to freeze natural gas, take it down to negative 260 Fahrenheit, make it liquid. So that's the liquefaction phase. And then you have to transport it. And then on the other side, you have to regasify it, right? And then put it into pipelines. So the cost of that combined toll, okay, if you will, the liquefaction plus transport plus regasification toll is anywhere from like $2.50 to $3 per MMBTU. So at current natural gas prices around call it $3.50, that's a 70 to 100% toll on being able to transport it. But we're still not to the point where we have a global arbitrage, right? So right now, I believe, again, referencing the numbers that I came up with in my piece, I believe the export capacity is between 16 to 18 BCF. And there's a lot of capacity coming online between now and the end of the decade that's almost going to double that to roughly 30. So people don't think that the global arbitrage will be really fully open and that we'll have excess export capacity until the end of this decade. But the other nuance about this is that even when we have that that excess export capacity, in many cases that arbitrage is unidirectional. So remember I talked about how some of the early projects like Sabine Pass had originally built for import. They had the regas facilities built. and then they shelved those, and then they tacked on the liquefaction trains, right? Well, if there turns out to be a global gas glut, those facilities could potentially be retooled for import. So we could potentially, wind up importing, right? But again, remember that there's this transport toll, right, of almost 100% to current prices with respect to transporting natural gas. But here's the other point. That's only part of the facilities. A lot of the newer facilities don't have the bidirectionality of it. So for now, the arbitrage is unidirectional. So it only results in demand pull. It won't have supply push unless there is a very long period of protracted glut in global gas that exceeds Henry Hub plus the transit and liquefaction and regasification toll. You see what I'm saying?
And you believe that glut would only occur if there's a sustained period of high prices that would bring the capacity or the production online.
Yeah, exactly.
Okay.
Exactly.
So I know that this is something you do have some new irons in the fire, and with the caveat that none of this is solicitation or investment advice or anything like that. This is something that you're putting your money where your mouth is and trying to make investments in this. What are you thinking about in terms of how to play this potential shortage of natural gas that you see?
I've thought about this a lot, and yeah, the irons in the fire you speak of are that I recently partnered with a natural gas minerals fund, basically, whose strategy is to go and acquire minerals interests in natural gas. And the reason why I like this model, look, let's talk about the alternatives first, right? You could go trade Henry Hub, right? But I remember all too well the blow up of Amaranth in 2006. Natural gas is often referred to as the widowmaker commodity. It's a brutally volatile commodity, especially when it's still in a provincial commodity like it is, where it's subject to weather-prone volatility. So that's a non-starter for me. Related to that are, the associated equities, which can also be very, very volatile. But a big lesson I learned during the bear market in oil from the period of 2015 to 2018 is that, especially in the commodity sector, where the macro risk itself is already sometimes very hard to analyze, especially when you bring in geopolitical factors like the aforementioned Trump rug pull, right? It makes it even harder when you then add on idiosyncratic capital structure considerations with individual companies, and also what I call capital reallocation risk. So one of the big problems that I saw during the oil bear market between 2015 and 2018 was that a lot of management companies were their incentives were all wrong. They would make nice cash flow margins at the drill bit, but then redeploy that hard-earned cash into inferior projects, squandering that cash. So the investor never actually saw the cash, right? The reason why I like playing via minerals is that it's a pure play, but it's a pure play, but one that's not volatile like trading Henry Hub itself. Because if you think about, for those of you that aren't familiar with minerals, the U.S. has what's called kind of a split estate system, where if you own the land, if you own real estate, let's say farmland in Texas, right? And you've had geologic studies done on the subsurface, right? You as the landowner can actually get liquidity by selling off some of your subsurface mineral rights. These mineral rights are perpetual. So, you could have you could lease your land to an operator, which now has a working interest. The operator has basically the they'll typically only get involved if they have at least 70% of the underlying mineral rights to make it worth their while. But they're the ones that determine how much money to spend and when to drill. Now, there's also a separate market for just minerals, right? There are people out there that buy minerals. So like my new venture here is that they're basically acquiring minerals and not having to take the capex risk. That's both a blessing and a curse, because when you buy minerals, all you can do is buy at the right price and try to underwrite try to assess the probability of when the acreage will get drilled. And so there's both art and science to it, right? The science comes from analyzing the type curves and looking at the geology, determining whether or not, if you as an operator, if you're an operator, whether or not you would drill that acreage in the first place, right? That's the science behind it. The art behind it comes from really understanding the operator behavior in the basin that you're looking at, and looking for other clues on whether or not they're about to drill. So so that's the reason why I like that particular expression. Excuse me.
And when you're talking about buying at the right price, are you assessing mineral rights on a dollar per million BTU basis?
So that actually is a great question, because some people ask about, oh, what's the dollar per net royalty acre and blah blah blah. And I know that my partner Ralph would say that the not all acreage is the same, right? So the real way, the consistent way to look at it is, where do you think you're creating natural gas reserves at? So again, if you go down to like $1 per MCF or $1 per MMBTU, however you want to look at it, the idea here is to create reserves below $2, right? And again, referring back to that long-term chart of natural gas, right? You see that even during the worst of times in terms of gas fundamentals, you really never saw natural gas stay below 250 per MMBTU for very long, right? It definitely trended along there for long periods of time. But if you can control how cheaply you acquire and essentially create your reserves, then that's the risk mitigation aspect of it, right?
You talked about the oil rug pull from the Trump administration, and we talked about the difference between oil and natural gas. Why, if you believe this is so important, natural gas is increasingly important, why won't there be another rug pull from the administration? Why aren't the same levers that are there for oil there for natural gas?
No, they're totally different levers, because there is no, first of all, it's not a global commodity. There is no OPEC of natural gas with a ton of spare capacity that they can just unleash on the world, right? I guess the closest thing would be Qatar, right? But again, there is no global arbitrage. So even if Qatar all of a sudden was able to unleash a huge amount of gas onto the global market, there is no global arbitrage yet. And B, when there is a global arbitrage by the end of the decade, it's mostly going to be unidirectional out of the US and not back into the US, right? So it will take a long period of time and a very protracted period of protracted period of global supply glut for that to happen, for basically for the facilities here to get retooled to be able to import. Remember, transporting gas is not nearly as straightforward as transporting oil, because you have to have a truly bi-directional global arbitrage. You need to not just have liquefaction on one end and regas on the other end. You have to have both liquefaction and regas on both ends. And right now, we're just in the process of building liquefaction on on this side and regasification on the European side. So you see what I'm saying?
Yeah. So do you think this is understood at the highest levels?
There is the concern, some people will say that in addition to the baseload generation bottleneck that I talk about, what about this transmission bottleneck, right? One chart that was very scary in that Michael Sembelis piece from JP Morgan was that there's been a complete lack of investment in transmission capacity over the last 40 years. It's been a consistent decline. And one of the questions that I get is, won't we hit the transmission bottleneck before we really even have a generation bottleneck? The reason why I don't think we will is because if you look at the hyperscaler behavior right now, you're actually seeing them recognize that there is this transmission bottleneck, and there's this trend towards what is called behind the meter co-location, right? So they're actually, if you look at like Meta, a bunch of these hyperscalers, they're not figuring out where they want the data center and then bringing the gas generation or the electricity to the data center. They're figuring out where the lowest hanging fruit sources of energy are and then relocating the data centers there behind the meter, behind the grid, so that they don't need to worry about transmission bottlenecks in the first place. And that's the reason why Haynesville has become kind of popular for natural gas, is that Haynesville is one of these areas where, unlike West Texas, that is subject to West Texas in the Permian Basin and the Midland in particular, you've probably heard of certain basis blowouts and the Waha basis and whatnot. And that results from the fact that in West Texas, most of the drilling is for oil, right? Shale oil, right? With shale oil, a lot of associated gas comes out. And in West Texas in particular, there are some offtake bottlenecks sometimes for that associated gas. So much so that a lot of times the gas has to get flared and just wasted, right? Well, in the Haynesville, you don't have that problem. The Haynesville happens to be located pretty close to the Gulf of America, right? All of the LNG export terminals. So there's easy offtake, and that's the reason why I believe, like for instance, like the Meta data center they're locating it right next to the Haynesville. If I'm right that our geopolitical dependency is moving away from oil, and oil is in a potential structural bear market for a while, and to the extent that actually results in even lower oil prices and reduced drilling for oil here in U.S. shale, that will actually lower the amount of associated gas that's being produced. So it potentially, lower oil potentially exacerbates a coming crunch in natural gas, ironically.
So what you're saying is that a fall in oil prices actually would result in less production of natural gas, the exact amount.
In certain regions, certainly in West Texas, that would be the case.
Is it a problem in the areas where the data centers are going?
The data centers are all over the place, so it could impact certain areas. But I would imagine, though, that given the amount of money that they're spending, so here's a chart in my piece. I actually have a map of the data centers, and I think what is interesting about this caption is that it says the planned data centers are located near major natural gas producing basins, right? So there is a lot of this data center co-location going on to avoid what we talked about with the transmission bottlenecks.
Are these narratives about green energy powering the data centers, nuclear power powering the data centers, is there any evidence that is coming to fruition, or is it pretty clear that the industry has settled on natural gas?
It's not clear that the industry has settled on natural gas, in that if you look at where the hyperscalers are placing their bets, it's honestly all over the place, right? Like Microsoft, did this 3 Mile Island restart. And by the way, most of the nuclear deployments that I think you're going to see that will succeed are these restarts, because that's the lowest hanging fruit. It doesn't cost that much. But a greenfield starts are extremely expensive and take a very, very long time. So, for instance, like a greenfield start would potentially take 10 plus years, and whereas to start a natural gas powered plant takes maybe like 3 years, right? So it just depends, because like Microsoft opted for this 3 Mile Island restart. Meta is all over the place. Meta notoriously is pursuing the shotgun strategy, where they're doing some geothermal, they're doing some nuclear, but they're also doing a bunch of natural gas. Elon Musk's XAI recently deployed 33 natural gas turbines. So they're all over the place. But one thing that we didn't mention that I think is worth mentioning is that in this massive data center land grab, you've seen for the first time some of these hyperscalers go from a net cash position to a net debt position. And I posted about this a couple of times, where I used a picture of Arnold, right? The governor. I call it the debt governor. The debt governor. Things change. When you are fueling all of this with funny money equity investments, it's one thing. But if you start fueling these data center buildouts with debt, and prodigious amounts of debt, enter what I call the debt governor, because it'll shine a spotlight on ROI and time to profitability for these projects in such a way that I think, again, for all of the aforementioned reasons of both time to market as well as lowest cost, I think that's what favors natural gas over all of the other sources of baseload.
You talked about the funny money, the equity funny money. I think anybody who is skeptical of the AI build out would say that that's one of the bigger risks to your thesis. How much of the thesis is tied to the AI data center build out? And if we do see negative return on investment and a slowdown in this build out, are you concerned about nat gas, or is the overall electrification demand megatrend enough to power through a popping of an AI bubble?
I actually think that in 10 to 20 years' time, we might have a glut of compute and a glut of energy overbuild. We very well may end up in that period. But in the shorter term, in the 3 to 5 to 7 year period, I think there is the potential for a real squeeze on our grid, and therefore natural gas. So I think that the reason why I think that the demand is going to be relatively inelastic in the short to medium term is because of these three factors coming together at the same time. Remember, I keep going back to that chart that says for 15 years, we've basically had flattish electricity growth, right? For the last 3 years running, we've had consistent upward revisions, and now people are thinking that we could have 2.5% to 5%, and that's, to use a pun, that would be a real shock to the system. And so if that and each one of these trends, each one of these mega trends that I mentioned, this premature electrification, the AI data center land grab, and the LNG export, each one is a formidable tailwind in and of itself. But to have three of them, to have the whole trifecta come together at the same time, I think is going to be problematic. And that's what inspired me to write the whole piece in the first place, because I just find it just so ironic that in an effort to decarbonize, we have essentially created two trade-offs that are the geopolitical trade-off and now this hydrocarbon trade-off.
Of the three sort of tailwinds, the electrification one is happening no matter what.
Has happened and is going to continue to happen.
Yep. And then you have the import export aspect to it, which, as you said, is going to take years to fix, and it's likely only going to happen after a price spike occurs and you have a glut.
I think that it's going to take years to get to unidirectional arbitrage. And then for us to have true bidirectional arbitrage capability and have natural gas be like, WTI and Brent. Like right now, we've got TTF in the EU. We've got a different metric, a different benchmark in Asia, a different benchmark in the North Sea, right? So all of these are provincial commodities. And the reason why they don't track like WTI and Brent is because there is a lack of global arbitrage.
So the one that actually could potentially come undone the fastest would be the AI data center build out. That in theory, they could all decide tomorrow, we're turning off the capital spigot. So of the three, that is the one that is the most time sensitive probably.
And that's, again, the reason why, I've thought long and hard about my choice of expression for this bet, right? If let's say I'm completely wrong about these mega trends and none of it happens, or the AI bubble bursts and we go into, and natural gas never takes off. And by the way, I don't expect I'm not calling for a straight shot bull market in natural gas. The way I characterized it in my piece is I expect there to be kind of like a rising sawtooth pattern where maybe a series of higher highs and higher lows. Because after all, when it's still provincially trapped, when it's still a landlocked commodity, you're going to have those spikes. But as we near the end of the decade and we get to the point where we have global arbitrage, at least unidirectional arbitrage, I would think that some of the weather volatility begins to mitigate, and it takes on more of this characteristic of a global commodity. So I kind of expect a rising sawtooth type of bull market. But let's say it doesn't happen. My point is that even if it doesn't happen, if you look at the long dated chart, again, going all the way back to 1991, right? You just don't see natural gas going below $2 per MMBTU pretty much ever.
Yeah, like you see $1.50 in the worst times.
Yeah, not really. Maybe for like a millisecond, it doesn't stay there, right? And so this is why I think the role of underwriting and price discipline, acquisition discipline, is of paramount importance. Because if you're able to create, my partner Ralph thinks that we can create reserves anywhere between $1.60 to $2 per MCF, which is close to per MMBTU. That to me is a margin of safety, a decent margin of safety. So like, we don't care, if the worst that can happen is that you are making less money, then I'm really happy, right? I just don't want to lose my shirt where that definitely can happen if you're actually trading Henry Hub or investing in public equities. Okay. Right?
And so obviously there's the price discipline. How much are you thinking about geography?
I'm not going to speak for Ralph. This is where I think the art versus the science comes into play. But what my partner would say is that it's not so much chasing data centers as it is really trying to figure out, knowing what the operator behavior will be. Like there's certain operators that might have the reputation of hoarding inventory and filing a drilling permit without necessarily wanting to drill imminently. And so it's incumbent on him to know that and to suss that out and to figure out maybe what other clues can we glean? What do we know about what he's done in the past to underwrite that risk, right? So I think it's such a fascinating asset class because you have to both think like an operator from a geology standpoint and figure out, okay, is this rock that I would want to drill? And once you pass that test, now you have to put on a completely different hat and say, I have to now guess what what the operator of this in this drilling unit will likely do and when.
Well,
And that's the part where that's Ralph's competency, not mine.
in a scenario where this all works out, are you more likely to get paid on continuing cash flow from these rights, or the type of thing where you're getting bought out by these operators that you're talking about? What does a winning scenario look like?
Once these things go into pay, it follows the life cycle of like a typical shale well. You have initial flush production, so first couple of years you have a very high payout, and then with a very fast decline, and then by the time you've, let's say, distributed out 2/3 of your production, right, you go into this what I call a tail period, right, where the last third comes out, and it asymptotes out over a long period of time. And what I'm also learning that I find fascinating is that the market for mineral tails is actually more liquid than the market for working interest tails. And the reason why is because mineral holders have a perpetual call option on the future production that comes from these minerals. Whereas if you're the working interest holder, right, you have all your optionality can get shut off because of economic constraints, your CapEx constraints, where oil prices are, whatever, right? But if you own the underlying minerals, right, even if the operator of your drilling unit shuts the well down because of low oil or low gas prices, you as the minerals holder still own the future call option in perpetuity. It's truly, remember, you and I have talked about perpetuity options in the past. This is a true perpetuity option. It is an option that extends forever. And so because of that perpetuity option component of it, the market for the tail, for these mineral tails, is more liquid and tends to pay a higher cash flow multiple than working interest tails. You see what I mean? So like with working interest tails, usually once you get into this tail phase, right, you could either hold these interests forever and just collect smaller and smaller checks, or you can basically just try to sell it to this market of, there is a whole marketplace of buyers. It could be, say, like a royalty trust, for instance, buyers that basically assemble these tails because of their predictability and cash flow stream, right? That's a whole other market, right? Somebody wanting to buy the tails. But because of that, right, because of the perpetuity option aspect of it, it provides a nice exit strategy once you get to the tail phase. The big question that you haven't asked that I'm going to anticipate is, and I've wondered this myself, is that, look, at some point, right, if natural gas prices really do go, like if you call the current floor 2.5 to 3.5,
yeah,
and let's say that we reset to a new floor of 4.5 to 6.5, right? Well, do you expect minerals prices to go higher? Of course. Of course I do, right? But my understanding from my partner is that the prices, they tend to be kind of sticky above and below certain breakpoints. And he would say that unless you see a protracted period of, strip pricing, not just spot pricing, but the entire strip, staying above, call it $4.5 to $5 per MMBTU, the marketplace for, especially for smaller deals, these smaller minerals deals, it tends to be pretty sticky. It doesn't like necessarily ebb and flow, and so you have total control over your discipline. And when you underwrite smaller deals, you're able to have more underwriting alpha, right? Versus buying like a package of 20 million of minerals, right? Because when you're underwriting smaller deals, you can cherry pick the acreage.
You did anticipate my question of the world, like the world of the current floor and then maybe a future higher floor. What is the risk that we reset to a lower floor?
I invite you to tell me what would cause it, because if we haven't seen that since 1991, a lower floor, meaning, below $2, what would cause that? And, I suppose you could say that, okay, let's say we're 15 years down the road. And hopefully, this, by the way, my thesis right now is really for the next 3 to 7 years, really. But let's say we do get into this sort of energy overbuild situation. Well, then, that's the scenario. I don't necessarily think that you want to be in this play, 15 years out, because I do think that there is the potential for an energy overbuild. There are some real dollars and cents considerations, right? Especially when you factor in the amount of debt being thrown at these projects, because I just think that, none of the other sources of baseload are going to do the trick. And if they are spending, trillions of dollars on these data centers, they're going to need this energy at some point. But again, that's only one part of the trifecta, right? There's another chart in my piece that tries to quantify it. And it basically says here, and the source is the EIA, it shows you that the demand pull from LNG exports is significantly higher than the demand pull from AI. The reason why I think this thesis works is because you need all three of these things to really fail, at the same time, and when the opposite is actually happening, right? We've had this electrification trend, we have AI and LNG all happening at the same time. So we've never had a period of electricity demand going down. That's the other thing, right? Even during the flat period of 2005 to 2020, it was 0.5% electricity growth, with natural gas powering the majority of that electricity demand, right? So you take that and you overlay it on that 1991 to present chart of natural gas prices, and you see that, okay, and that flat period is when we've had all this weather volatility, but in that period of flat growth, you've never seen natural gas really dip below 2.5 per MMBTU for sustained periods of time. So the question I ask is, now what happens when this trifecta happens to electricity growth, and the only real lowest, the lowest common denominator, or the lowest hanging fruit from a baseload generation perspective, is natural gas?
Yeah, well, I think that's a great place to leave it, Michael. Anybody can read this write-up that you wrote on your Substack, which is Cowboy Musings, and your Substack handle is @UrbanCowboy. It makes it easy because that's also your Twitter handle, @UrbanCowboy.
Yeah. My Substack is actually urbancowboy.com, so it's the same. Yeah.
All right. Well, we'll leave it right there. Michael, thank you so much for joining us.
Thanks for having me.